Hi guys, welcome back to the channel. My name is Dave, and today we're talking about REITs. In particular, we're going to be talking about APTS. Armpits. No, that's not right. Apartments. That makes more sense. Preferred apartment communities. This is a REIT that I like, that I've been accumulating some shares. And as we do on this channel, sometimes I look to sell the covered call to stuff some extra money in my pocket. So, if you're interested and that's what you're looking for, please stick around. Whoop. Should start to consider this like a little bit of a mini series as we're starting to talk about REITs and monthly dividend paying stocks and combining all these with covered calls. But as I explore this space more and I keep looking around, I do these types of trades quite often, and I think it really does help enhance my portfolio over the long run. Now, full disclosure, I do own my own real estate. I have industrial buildings. I don't have any apartments at all because my mentors have kind of steered me away from that over time. Every time I think about it, I should get into apartments. They're like, well, they're going to call you in the middle of the night. The faucet's leaking, the light bulb burned out. Whereas with industrial buildings, typically you're dealing with business owners and they handle a lot of the internal stuff and you cut the grass. It's usually not too bad. So in that respect, I do like REITs. I love to have REITs in my portfolio to cover things like apartments. And in case you're not familiar with REITs, they're real estate investment trusts. And there's a few different kinds, but in this case, we're focused on the ones that are buying real physical real estate. They're collecting rents, and then they're paying out the vast majority of that income to those that own the stock. REITs are simply a way to buy the stock and not actually buy the physical real estate, still get some of the nice perks. Another great aspect of a REIT is the fact that it hedges against inflation, right? Just like the rising tide of inflation, and you've got a little boat out there, that's our REIT or our real estate, and it rides up as the tide rises. Whereas your iPhone and your Microsoft, well, they're going to sink a little bit with rising interest rates and a rising tide of inflation. So something to consider because we want to be broadly diversified. So maybe think about putting some into a REIT. There are plenty of other ways to break down REITs, but I do like to keep it kind of surface level when it comes to this stuff. So when it comes to what they're buying, in this case apartments, grocery stores, things I think are going to be around for a long period of time, I feel pretty good about. Then I would stare at the core management team and see who they are, where are they going. So are they accumulating shares or are they selling off a bunch of shares? What's going on within this REIT? So preferred apartment communities is just like it sounds. They own apartment buildings and they have some grocery stores and that type of thing in there as well. But when you buy into a REIT like this, if it's well managed, well taken care of, they have a good core management team around it, it's almost like owning the apartments. You lose some of the perks, but over the long run, by investing into this, you should get a solid return over time, and they pay a nice dividend. So by combining all that with a covered call, our question is, what kind of return can we get on this investment? And when we start talking about REITs, we always want to talk about FFO, funds from operations, or PFFO. This can be our substitute for PE ratio. And I guess the $2 explanation of this is we want to add back depreciation. So as just a basic example, let's say you went out and you took 100 grand and you bought an apartment, right? And you went out and you started collecting rent on that apartment, $1,000 a month. And you had some expenses. So $300 in expenses, you ended up with $700 a month, right? That's your income. But wait, the government allows us to take depreciation against this appreciating asset. Typically goes up in value, right? Real estate. So you take that $700 and you take your depreciation expense of maybe another $400. So you only show a gain of $300, but you really made $700 while this is going on. So you take that in the form of a REIT, and these big depreciation numbers can actually throw you into a loss. And that would be reflective if you said, here's my PE ratio, I lost money. But in reality, we're going to add that number back in, and we're going to get this PFFO number because we know that's just a paper loss number. So as we look at these, always look for your PFFO number. And I would say something under 20 is typically a decent number. The lower, the better. So all that information is out there ready for you to use. But let's take a look at the chart real quick and some of the fundamentals, and I'm going to show you why I decided to make this trade. Okay, so let's do a really quick analysis on preferred apartment communities here. And if you go to the website, you're going to get lots of great information there. Of course, it's going to be the gloss, pretty picture version, but that's okay. We can go here, we can look at the portfolio, we can kind of see they're spread about, right? Everything from Kansas and Georgia to Texas to apartment complexes, 300 units, 218 units. To Publix. Scroll down here, you're going to see Harris Teeter, you're going to see Kroger's. So pretty well diversified and spread about. So it looks pretty solid. And you can check this out more. I would suggest if you're going to invest, you take some time and you do some reading. Now, if I go to the leadership here, you're going to see Joel John and who the leadership team is. And I know Joel, I looked him up. He has about $7.5 million of stock right now. So, and he's not selling. So that's a good sign. That means management's there and they're hopefully on board. They want to see it grow as much as we do. So, when we're looking at all this portfolio that we can buy into and own a little portion of all this with our stock ownership, not a bad way to play it. So apartments then, if we go over here to the chart, we're going to see dividends and earnings. We're going to see that it's grown quite a bit over last year from 8 to almost 14. Does that deter me? No, I've been buying right in this area here. They don't have the new earnings coming out, but that's what that spike is right there. It went up about 7% after earnings, so it's pulled back just a little bit, but I still feel comfortable buying at this position. Now, if we go back over and we look at Seeking Alpha, we can find that FFO and that PFFO number that I was talking about, and this is a FWD, forward PFFO, so based on future expected earnings, and it's 13.25, so that looks pretty solid, and a yield of 5%. So if we look a little bit deeper into those dividends to understand them here, we're going to see that pays out 5%, and that's a payout ratio of 67.31%. So they're paying out 67.31% of what they make. And a 5-year growth rate of negative 2.39% doesn't look great, but we understand that COVID did occur, right? We're not blind to the fact. And if I look at dividend history, it's going to show us, yeah, it was growing. They were doing a pretty good job of growing that dividend, and then COVID hit. And it's dropped off and stayed at 18 cents ever since. But with that payout ratio, they do have room to grow and hopefully add to it over time. So why not invest now? So I feel pretty good at this entry point, and that's just our real quick analysis. Something else before I show you exactly how I played this trade. I'm hoarding a bit of this one because I like it so much and I think it's a good long-term hold. So maybe a good strategy would be to go out and buy 100 shares and sell the covered call. But maybe a better strategy would be to go out and buy 110 shares, sell the covered call, and effectively offset those last 10 shares and put those in your pocket for the long term. I mean, it's like free shares. It's like signing up for a Webull account. I mean, you can't go wrong there, right? So something to consider. If this is something that you like, maybe you accumulate some shares for the long term. But honestly, when I started to evaluate this trade, what I loved the most about it was selling the covered call against my 100 shares. So yes, I am doing that with the bulk of the shares that I have owned. But it's almost like that, the saying about spotting the sucker at the table. I think I've spotted the sucker at the table, and I'm selling the covered call to him in this case. So I feel really good about this trade, and I'm going to walk you through exactly how I did on Fidelity and show you the results. So I started accumulating shares of APTS right around $13.50 to $14 per share, blocks of 100, and I was turning around and selling the covered calls. So I'll walk you through exactly how to set that up on Fidelity in case you're not real familiar with covered calls, but it's just like you see it here. Fidelity, sell it open, one contract, a call. And you can look at your expiration and pick out what you want. Notice the ex-dividend dates and earnings are all listed. So if we look at the December 17th, $15, for example, and you can kind of play around because it's at 13.7 right now. So if we look at the $15 strike, which means it's out of the money, and we can actually make some money if it actually goes up, you can. But if you wanted to sell in the money, you could. But it has to make sense if you sell in the money. I'll link a video above if you want to sell in the money. But you can see how big that bid and ask spread is. So that's quite substantial. So you're going to have to be really careful if you execute this kind of trade and make sure you set your limit properly. But in this case, I really like the April 14th, 2022. So going out about 5 months and looking at the bid and ask for that particular one. Now, looking at $12.50 for in the money, maybe it makes sense if you want to guard your downside. Again, go watch that other video if you're not sure. But for each one of these contracts, you get $104. But if you think about it, at $12.50, that doesn't cut it at that bid price. So you definitely have to get closer to that ask price, or at least the midpoint is cutting your break even. So I didn't really like that particular trade in this case. And I think a better option is to sell the $15 out of the money strike. So let's take a look at the $15 strike. You'll see you get a 65-cent bid price, so $65 per contract, and ask about 75. So more reasonable spread there too. But look at the volume, how low it is. So whenever I see a volume that low, I am never going to do a market order. I'm always going to be doing a limit order, even if I set my limit at the bid price. So That's just a warning of caution. And you can set it, you can try to get to the midpoint. Maybe you can set it for 0.7. But you just don't want to really execute a market trade. I really suggest small volume, set your limit price, and then adjust as necessary. You can always replace it. So be it. But that's $65. Preview and place that order. Think about it. $65 per contract is quite a nice return, and we'll run through the numbers right now just to prove it. All right, so here's the tail of the trade. What do you think? Purchase price, $13.65 per share. Now they pay a 72-cent annual dividend rate, or 5.3%. And we sold the 4/14/2022 expiration, $15 call, which paid us $66.32 that we got to put in our pocket today. That's 157 days till it expires, so 157 days from now. But if you annualize that return, that's 11% annualized return on just the covered call portion. That's pretty darn good. That means it's a straight 4.9% straight return. And between the call premium and the dividend, this is a nice 16.3% return. Pretty darn good. So effectively, by selling this call, we reduced our basis, right? We paid $1,365 per 100 shares, but we just collected $66. So effectively, we're at a basis of $1,300 for those 100 shares, or $13 per share. And of course, before we enter a trade like this, we want to talk about potential outcomes. So if the stock goes up, are we satisfied? If the stock trades sideways, are we going to be okay? And if the stock plummets 15, 20%, what's our reaction plan? So if we can justify all three of those and feel decent about each one, then it's a winning trade. So let's check our three scenarios. Stock goes up through the roof, whatever it is. We collect a dividend, we collect a premium of $66, plus we're going to sell this thing at $15 per share probably, and that means we're putting an extra $135 in our pocket, the difference between our buy and our sell price. It means we get $237.32, which would be a 40% return. Pretty darn good. Now, if it just trades flat, that's fine. I'm going to collect 16.3%, and I will repeat the same thing going out, probably rolling it out farther. Now, the down scenario, this is the one we're concerned about, but in this case, I like this REIT, and I will add to this position unless there is significant change. Something to this REIT that concerns me, that I do not want to be in this trade any longer. And most likely, if this is still between a $13 and $16 range per share price, then I will probably roll it out a month or so beforehand, as far out as I can, just so I'm prepared and can continue to do this. And maybe I can do this for the next 2 or 3 years. Who knows? But I like all of these results. Finally, as we collect these dividends, right, we're going to be reinvesting these dividends. We can do it back into this particular REIT, or we can buy something else. But that's all about dollar cost averaging, which I always like to preach, so valuable, and the time value of money, because we're collecting the $66.32 per contract premium that we get on day one. We also get to invest that, and $1 in our pocket today is worth more than $1 in our pocket tomorrow. So we're going to continue to invest that as well. So that's my trade with APTS. I always like to put a little bit of money into REITs. Again, like we talked about, rising inflation, diversification, all really important. And I think this is a good positive trade for me long term. And then one of the reasons that I'm accumulating shares, I'm not just selling the covered call against everything that I own with APTS, a REIT. So please like and subscribe if you find any of this interesting or helpful. And we'll see you next time. Any questions? Ask down below. Thumbs up. See ya. What?